Recording in progress.
So good afternoon, everyone. It's a great pleasure to welcome you to this fifth FBFDiscuss. My name is Maria del Carmen Sandoval, and I'm a research associate here at the Florence School of Banking and Finance, a program of the Robert Schuman Center at the European University Institute. And I will moderate today's debates on whether at this stage, regulatory Pillar 1 capital requirements should be increased to reflect climate risk of certain assets. The FBFDiscuss series kicked off 1 year ago with an episode on a green mandate for the ECB. And this is the second time we will hold a debate on a sustainability-related topic. My colleagues and I are very happy to let you know that this September, we will have a brand new training course on green bonds and the sustainable bond market that will be delivered in a blended format. You will find all the relevant information soon available on the FBF website. For our new participants, the FBFDiscuss has a very interesting and dynamic format. Following well-known debating societies, the debate brings together two contestants to discuss a specific motion. It will start with a short opening remarks, followed with a rebuttal from both speakers, so that there is enough room for interactions with you all, including with polls and your anonymous votes on the motions. We also encourage all the participants to submit any questions you may have in the Q&A box that you see here in Zoom. So today, I'm happy to let you know that we have participants registered from more than 40 different countries and various sectors, of which more than 70% have a background in business and economics, but we also have very interesting profiles like lawyers, social scientists, and many others. So today's motion is, this House believes that at this stage, regulatory Pillar 1 capital requirements should be increased to reflect climate risk of certain assets, with two great experts on this topic, Julia Simon and Gonzalo Gazos. So at this moment, I will first like to invite all of our participants to vote in the first poll and answer the following question. At this stage, should regulatory Pillar 1 capital requirements should be increased to reflect climate risk of certain assets? Yes or no? As we know, climate change constitutes an important source of financial risk that has the potential to severely damage the economy and the financial system. Since the Paris Agreement of 2015, it has been widely recognized that financial institutions, and especially banks, play a key role in helping diminishing the effects of climate change and in supporting the transition to a low-carbon economy. They are, all we know that they are fundamental actors in contributing to climate change mitigation and adaptation. But at the same time, they are also exposed to climate-related risks such as physical, transition, and liability risk. In this sense, we know that there has been this wide, extensive discussion on which prudential instruments would be most effective in equipping banks with better tools to manage climate risk and contribute to the green transition. But as we know, one of the most contentious issues is related to the fact to the incorporation of climate-related risks into Pillar 1. We know that within the European framework, the Commission is already exploring the idea of adjusting capital requirements for green and brown assets and has asked the European Banking Authority to assess if and how capital requirements could be differentiated depending on the environmental and social impact of assets by institutions. And the final results of this analysis are expected already in 2023. And actually, 2 days ago, the EBA published an interesting discussion paper on this matter where it explored whether and how environmental risks are to be incorporated into Pillar 1 prudential framework, and already opened a consultation process on this. But let's ask ourselves, which is the best way to design tools that benefit climate-friendly activities while discouraging intensive credit? What are the most effective ways in which financial institutions can contribute to the low carbon transition and cope with climate-related risks? Should capital requirements be used as a policy tool to encourage green and sustainable investment, or they should follow a risk-based approach? So these are some questions that we will hope to answer it in today's debate. And for today, we invited 2 experts on this timely and relevant topic. So let me introduce them. First, our proponent, Julia Simon. She is head of research and advocacy at Finance Watch. She joined in January 2021 and recently became head of research and advocacy. Her work has been largely focused on banking, partially insurance prudential regulation, and climate risk. Prior joining Finance Watch, she spent 10 years in the banking sector in Frankfurt and Munich, working for an internal audit, eventually as a senior audit manager. Julia Simon holds a master's degree in international economics from the University of Constance in Germany. Welcome to FBFDiscuss, Julia. We are delighted to have you on today's debate. And second, I would like to introduce our opponent, Gonzalo Gasos. Gonzalo is Senior Director of Prudential Policy and Supervision at the European Banking Federation, leading the department in charge of risk management, supervisory practices, crisis management, and economic analysis and reporting. He is a member of the EBF Management Committee, Secretary of the Banking Supervision Committee, and member of the Advisory Board of the European Banking Institute. Mr. Gasos coordinates the EBF prudential policy as well as the interaction between banks and the ECB single supervisory mechanism in Frankfurt and the single resolution mechanism in Brussels. Gonzalo, it's a great pleasure to have you with us today. Thank you very much. So before starting, I would just like to mention a few housekeeping rules for the audience. So just like we did a few minutes ago, you will be asked some questions during the debate, and please, for the audience, participate in these poll questions. And of course, I remind you that all the questions can be answered anonymously. Please use the Q&A box to answer your questions during the debate, and we will come back to those afterwards at the end. Our speakers have limited time and will be interrupted in case time is up. If you wish to engage in these conversations in social media, especially on Twitter with the hashtag FBFDiscuss, please do it. We will be publishing the results of the polls in our FBF Twitter account. So just before passing the floor to our proponent, I would like to highlight the results of the first poll. In case we have them now, let me check. So around 53% of the respondents thinks that at this stage, regulatory Pillar 1 capital requirements should not be increased to reflect climate risk of certain assets. And only 47% think that they should. So we have like very close percentage here. So now we have another poll for our audience. So let me read it for you and please vote. In your view, the reduction of capital requirements for green assets by applying a green supporting or adjusting factor could eventually A, increase green investments and redirect flows from ground to green activities, or create a green bubble in the market, or rather increase a financial stability risks, as green doesn't necessarily mean less risky, will have no effect, or will place a right incentive for certain asset if it's risk-based and subject to EBA analysis. So please vote on this poll. So while you vote, we are ready to start finally with our opening remarks from our speakers, and they will be followed by a short rebuttal from both sides. And don't forget, please, to keep engaging in these polls. Julia and Gonzalo, I remind you that you have each 6 minutes for your introductory remarks with clock. Julia, please, the floor is yours.
Thank you, Maria, for the kind introduction, and thank you for the opportunity to be part of this very important discussion. I think Maria already made a very good outline of the situation where we are at and of the risks that banks and other financial institutions facing due to the climate change. And as we speak about the prudential regulation today, I think we should take a moment and reflect on what should be actually the role of the banks in the course of the transition. First and foremost, I will argue the role is to remain stable, to make sure that the banks can support this transition with their activity and fulfill on their role in our economy, meaning that financial stability is at the heart of this discussion and should be also at the heart of what we will be thinking today and also in the months and years, I believe, to come. Capital is the core tool that the banks have to cover their risks and also ensure that the banks remain solvent in case of the crisis. And arguably, of course, climate change is one of the biggest threats that faces our humanity today and which will undoubtedly bring losses to the banks. So it is very important from the prudential perspective to make sure banks are well capitalized to cover those risks. At the same time, we also have the recognition in the supervisory and in the regulatory community, as well as in the scientific community, that currently the capital requirements do not yet account for the climate-related financial risks. This was mentioned by the ECB last year when it recognized that the risk weights do not yet take into account the climate risk. It is also mentioned in the ECB in its review of the supervisory review, where it came to the conclusions the banks are not yet in the position to adequately identify, manage, and monitor climate-related financial risks. Not even speaking about that, the banks are not yet even adequately disclosing those risks. As Maria also justifiably outlined, supervisors and regulators have embarked on many exploratory exercises to better understand where those risks are and what should the appropriate prudential measures be. We have seen a lot of climate scenario analysis. We have seen a lot of data pilot exercises to understand the exposures of the banks. However, we should also very importantly note that all of those exercises have been mostly exploratory and have not yet resulted in any prudential measures being taken. So it means that effectively the exposure is left uncovered and it jeopardizes the future stability of the banking system, and it also puts taxpayer at risk of the next bailout. We also had recently the IPCC report, which also mentioned that the climate-related financial risks are not yet priced in, and that it will also take some time for the prices to reflect those risks. And in the meantime, while this whole exercise of exploration continues, I argue that there is a very clear case and a very clear set of climate-related risks which can already be addressed today based on the risks associated with those exposures and also based on the evidence which is available from the climate science first and foremost to address those risks. In particular, these are the risks associated with fossil fuel exposures. The climate science tells us that we already have 6 times more fossil fuels explored and available than we can consume in accordance with our climate budget, carbon budget of the planet, meaning that also that there is no room for the new fossil fuel exploration in any plausible scenario where we'll still want to stick to our commitments and keep the global temperature rise to below the 2 degrees Celsius. I'm not even speaking obviously about 1.5 degrees. We know that based on the scenarios by the International Energy Agency, which clearly confirmed that there is no new fossil fuels in the 2-degree scenarios, and they also have very clear reduction targets for the consumption of existing fossil fuels. These amount to 90% of the coal, 60% of the oil, and 45% of gas. Meaning that if we take those numbers, we can very clearly, based on this evidence, calculate back and understand that there are huge stranded asset risks associated with those fossil fuels, in particularly with new ones, which will become entirely stranded because there is no plausible scenario of using them, and also enormous stranded asset risk in the already existing portfolios. Interestingly enough, even the fossil fuel companies themselves, such as, for example, the recent Shell report, put quite staggering numbers on the stranded asset perspective on their balance sheet. Recently, as I mentioned, Shell estimated that in the below 2-degree scenario, 90% of its hydrocarbon related assets will be stranded. We also have quite staggering numbers estimating stranded assets in the fossil fuel industry in the recent IPCC report. These numbers are in the on the scale of trillions of dollars. This means that we have a very clear case, risk-based, and I said an evidence-based case for already increasing capital requirements, specifically, of course, Pillar 1 capital requirements, to make sure that the banks build their capital buffers and are ready to support transition and are ready to withstand the losses which will be associated with further using those assets. Again, I clearly would like to stick here to the prudential perspective, to the perspective of financial stability, as we speak here about the prudential policy, and based on that, take appropriate measures. We also have to be very clear about the fact that we do not have further time to continue exploring without already tackling the very known and clearly stated problem, because again, there is a very limited time to act, and the risks of the disorderly transition and of abrupt stranding will be even bigger.
Time is up, Julia. Thank you. Many thanks
you
for these remarks. So now we have again a poll for our participants. So in your opinion, highlighting banks' capital requirements for brown assets will create incentives for supporting green economy activities, reduce banks' ability to cope with unforeseen risk and harm financial stability, support financial stability as banks will be able to cover climate-related losses, decrease the availability of funds needed to transition finance, or make financing transition more expensive or not available for certain sectors. I recall our participants to vote on this poll. And now it's my pleasure to pass the floor to Gonzalo. Gonzalo, the floor is yours, and I recall that you have only 6 minutes. Please.
Thank you, Maria. It has become very clear to me that it's 6 and only 6 minutes. Good afternoon, everyone. With no further delay, I will expose my reasons why I oppose the motion about increasing Pillar 1 requirements at this stage. You will remember that 2 years ago, on a day like this, in Florence, in Frankfurt, in Brussels, and all across Europe, we witnessed how governments, supervisors, and regulators asked banks to reduce their capital ratios in order to keep on financing the economy after the outbreak of the pandemic. We learned 2 lessons. First, the prudential status of the banking system is solid enough to withstand a major economic shock. Second, despite being robust, the EU regulatory framework is a bit too rigid. Too much weight has been put on Pillar 1 measures, so much that authorities were trapped when they wanted to save the economy. As a consequence, you will remember a regulatory quick fix had to be improvised in order to ease off Pillar 1, letting banks play their role as part of the solution. Since then, a global debate is open about how to make the prudential framework more flexible. Against this background, the motion of this debate, I think, is a bit out of step because it offers just the opposite, to increase the level of hardwired Pillar 1 regulatory requirements, making the prudential framework in Europe more rigid, but not more robust. Talking about robustness, let me share what is the picture of the European banking sector in terms of the capital stack these days that you will see in the screen. Is that right, Maria? Can you see it?
Yeah.
Okay, so this is the stack of core equity capital ratio today that explains what we have done in the last 12 years, accumulating capital. And importantly, banks are reserving almost 5% voluntary buffer over fully loaded minimum requirement. Increasing Pillar 1 at this stage for risk that might materialize in the future will not add resilience. On the contrary, that will tie the hands of supervisors and authorities again if they have to react to any challenge in the meantime. And believe me, there will be challenges. As a point in case, we have just contended with 2 black swans in only 2 years, a pandemic and a war resulting in soaring energy prices. And more importantly, a brown factor would limit the capacity to finance the transition of European companies towards low carbon production methods. This is especially important because of the financing needs of the European economy that have been measured by the European Commission in about 390 billion per year required to finance the energy system in order to replace old power and industrial plants. Together with other sustainable objectives, the additional financing effort exceeds 500 billion per year. To put things in perspective, that is more than the current annual net flows of funding in the euro area, including bank credit, debt, and shares. So we need all of our munition to finance this ambitious project. Against this background, imposing a brown factor at this stage can only detract the scarce funds so much needed to finance the transition. But importantly, we also need to look at what is happening, what European banks are doing. And we've had access to a report now very recently with factual data covering 60 of the largest banks in the world and almost 3,000 fossil fuel companies, so very representative. You can visualize the results. The European banking system has reduced 27% its financing of fossil fuel companies in 2021, and without needing any brown penalizing factor. Honestly, the only problem I see in that trend is that it is perhaps a bit too fast. Next winter is going to be very cold. In the face of this evidence, proposing a brown factor for Europe is barking at the wrong tree. Let me sum up the 3 points I wanted to make at this stage. First, the EU prudential framework is solid. Far from complacency, we need to keep it and maintain it, but we have built something very strong during 12 years. It has withstood 2 major economic shocks, being an integral part of the solution. Second, the priority of EU policy should be to let banks finance the transition of companies towards low carbon production patterns, which is a formidable endeavor, and we need to put all of our capacity of finance to that goal. And thirdly, a brown factor, which is the question of today's debate, is not only the wrong tool, but a very unfortunate one, because it would raise serious concerns and problems of access to energy for European citizens in the short term. We need to keep a balance between the energy needs now that still are dependent on fossil fuel and the timeline of the reduction to net zero to finance that transition. And a brown factor wouldn't let us strike that right balance, and that would be for the suffering of European citizens that need to have that access as long as we go replacing the brown finance with green one. Over to you, Maria.
Thank you very much, Gonzalo, for giving the time. These were very interesting remarks, and I see that there are many points in which you both disagree. So I would like to remind you that now we have some minutes, you will have some minutes each for a rebuttal to react on some of the main points raised by the proponent and the opponent. And for our public, please feel free to already start typing your questions in the Q&A box, and that we will come back to them when in the Q&A session. So let's go to the rebuttal. Please, Julia, the floor is yours.
Thank you, Maria. I will allow myself, of course, to disagree with some of the major points made, and also put the discussion, let's say, in the right on the right path, because we do not mean to dispute the overall capital adequacy of the banking sector, right? I think every financier knows that the rule of pricing the risk is that you have to price the risk, because if you, as a banking and as a bank lending provider, tell that you have to be able to finance transition, you need to disregard certain risks. That's, I think, is also a misplaced argument. So the overall sufficiency of the capital is a totally different discussion. But like what we are saying here is that there are assets and there are risks associated with those assets, which means we have to put a price on that risk. Also, I think very important to keep in mind that in financing transition and recognizing the crucial roles of banks in there, we do not have a limited and finite resources of the banks, right? The banks can always raise more capital if they have good and profitable projects in their portfolio, especially the projects which are really associated with transition. So they can raise the capital and extend their balance sheet. There are no limits to that as long as the projects are in there. This is why I also do not see how keeping to finance fossil fuels really helps the transition in that sense. I would also like to stress that increasing Pillar 1 capital requirements to account for the risk does not mean that the financing becomes prohibitively expensive. This means only that the fossil fuel companies which pose systemic risks to the financial system and economy will have to pay the price of the activities that they generate. And looking at the dividends of fossil fuel companies today, I'm sure that they are perfectly capable of paying that price. We should not also mix the whole of the energy policy of the European Union and the banking sector, right? There are also important economic policy measures to make sure that renewable energy is available, that there is a transitory period, which we will also totally account for, because no regulatory requirement comes from day 1 to day 2. And again, capital charges do not have to be prohibitive. They have to just put an appropriate price on the risk. I'll stop here for now. Thank you.
Thank you, Julia. And now, please, Gonzalo, the floor is yours for a rebuttal.
Okay. Yes, my main question here is that if you look backwards, Julia, to the last 12 years, what we have done is to increase capital in different ways, but a lot of capital. So, I mean, you can always put more capital on top of capital, and then maybe one day you need to close the business. But that is not what we want. We want an optimal level of capital, which is probably where we are now, 15.4%. I think that is even more than what the Basel Committee thought when they started the reform a long time ago. We need to invest in other tools that can make us stronger to face up all the challenges that you have mentioned. Of course, we are in a very challenging world. And those, I wouldn't disregard or underestimate the capacity and the power of good quality information. That is what we are doing now. It is not that people are lazy and exploring things. No, there are real efforts, at least in the European banking system. I cannot speak about others. But in European banking system, take, for instance, the current stress test of the European Central Bank. It's not about the result. The most important part is not the result. I mean, if I were a supervisor, I would also be pressing banks, because you need to push the banks to do things, of course. But the most important thing is the amount of information that was not available before and is being raised with a lot of consultants discovering information we didn't have that will make us stronger, with a lot of energy certificates. All that progress counts and is valuable. And the next exercise will be even better. So this is a journey. And the way is made by walking. That is important. Now, when it comes to the question of capital, do you want to put capital in Pillar 1? I've mentioned before, it's not the right tool. It would have been the right tool maybe 20 years ago. Now it is not. There are other ways to look at the issue. And then apart from information, we need to consider that our regulatory framework is overly complex. We don't need to add another layer of complexity. You have, for instance, accounting. You mentioned stranded assets. That's something that we've been dealing with for ages, and the accounting system and also the prudential framework are ready to deal with obsolescence of assets, with sectors that undergo difficulties. It has been the aviation sector, the airlines in the past for different reasons. Then it has been hospitality, and we are there to help, part of the solution, but we don't cut lending to sectors that are in difficulty. On the contrary, we try to help them to finance themselves, and then at the end there will be victims, but that will only happen after the several years. We don't have to kill them before they grow.
Thank you very much, Gonzalo, and thank you both, Julia, for this rebuttal, which is making very interesting debate and arguments. But now I would also like to invite you both to comment on the results of the second and third poll. I will let you know that 21% of the participants think that the reduction of capital requirements for green assets by applying a green or supporting factor could eventually increase green investments and redirect flows from brown to green activities. Instead, the 41%, most of our participants believe that this will increase financial stability risks, as green doesn't necessarily mean less risky, while 30% consider that this will place a right incentive for certain assets if it's risk-based and subject to EBA analysis. So this is regarding poll 2. And on the third poll, we checked the results, and it's quite balanced, because 28% of our participants believe that it will make the heightening banks' capital requirements for brown assets will make financing of the transition more expensive and not available for certain sectors. And 25% believe that it will support financial stability, as banks will be able to cover climate-related losses. And the other 25% also consider that heightening capital requirements for brown assets will create incentives for supporting green economic activities. So I would like to ask you to shortly comment on the results of these polls in a couple of minutes, no more than 3, please. And this time we will do it in a reverse order. So first, Gonzalo, the floor is yours now for a few minutes.
Okay, well, firstly, I see that opinions are divided, especially about the brown factor. I haven't talked about a green factor. I think a green factor should be risk-based, and that seems to be the result of the poll. We need evidence, and I think the EBA in the report this week has made it clear that if they take any step in that direction, it would only be risk-based, what makes a lot of sense. However, let me say one thing. I mean, a green factor can help, but it's a second-order measure. I mean, we are doing more important things. So we don't have to place so much emphasis on a green factor. It might help, as we have had an SME supporting factor that has helped, but it's not a game changer. It just helps a tiny part, but very important, of the economy to cope with difficult situations. And then about the brown factor, it's a different thing, because in banking, in life, penalties have severe consequences. Incentives can produce results or not, but penalties can produce unintended consequences. And some of them have been reflected in the responses, which would be to deviate the attention of bank finance to stick capital in a pile that is already very big instead of using that capital to finance new projects, and also would make it, in my opinion, more difficult for the energy sector and other companies from other sectors to navigate through the transition. And our role is to help each and every company. Then there will be some that will struggle and will fail with the pass of time. But at this point, we need to support our corporate sector. A brown penalizing factor would only put more difficulties for companies that we have to presume they're doing their best. And that is, to me, the most important part. We don't have many corporate representatives in this forum, but I think that is the angle that mostly matters in this debate. It's not for the banks, but for the corporates, that the brown factor could limit their capacity to develop themselves and to go through the low carbon transition. It is not a binary thing, green and brown, but there are shades of brown, and many companies are investing, for instance, in changing production methods based on oil for natural gas, which is less emitting. So that is a trend that is happening. And in the future, it will be not natural gas, but probably other sources of energy that will help us with the net zero. That is the role we have to play.
Thank you very much, Gonzalo, for these comments. And now, please, Julia, would you like, please, to comment on the results of the poll? The floor is yours.
Sure. First, I think my first comment is I'm glad to see that our participants do care about the financial stability and take the financial stability into considerations. Especially, like, we have clearly seen that, like, I think with the vast majority on the question regarding the green supporting factor, because I think, as I outlined in my introductory remarks, we do not have yet an evidence that climate risk is anyhow accounted in the prudential capital requirements, meaning that as much as we would like to incentivize green finance, we cannot simply lower capital requirements just based on the fact that it's green or sustainable or whatever you might call it, because indeed something which is not reflected does not have a potential to be reduced. So this is very important, and this is also very important to make sure that we have the right price for the climate-related risks, because at the moment we effectively have the situation where sustainable or green is at a disadvantage and effectively has because we effectively have a kind of a fossil fuel subsidy in place, which is could be also viewed as the reason why we cannot channel as much financing into the green activities as we wanted. So I'm definitely happy about that result. And I think it's also very interesting to look at the result of the question about the so-called brown activities. It's quite divided. I think also quite positive that 25% of the participants do see also financial stability considerations and also do see the relevance of putting kind of green investment on an equal footing in terms of the risk treatment. I would like also, for the sake of our subsequent discussion, also make it very clear again that in my motion, as a proponent of our motion today, I do not mean to suggest Pillar 1 capital requirements for anything which could be called brown, whatever we would name brown. We are really in our work at Finance Watch and with this proposal, with this motion, I'm really targeting the fossil fuel investments because, as I said, these are a very clear case and there is an evidence for that, science-based evidence from the climate science. And of course, the other measures might be still appropriate for all the different other types of exposures, which based on the results of regulators and supervisors' exploration might be still deemed to be associated with higher climate risks. So I do agree that there are all other possible measures in there. And also, of course, maybe last but not least, we are definitely not speaking about penalizing activities or trying to do some kind of credit guidance steering in here via the prudential framework. We are very much sticking to the risk-based perspective. And this is why I would really not like to use like the penalizing kind of wording here and to stay within the financial stability considerations and within the function of the Basel framework, of the prudential framework for what it was designed for. Thank you.
Many thanks, Julia, for these remarks. So now it's almost time to open our Q&A session, but before that, I would like to ask our participants to vote again on a fourth poll that you can see on the screen. One of the most effective ways in which the financial institutions can contribute to low carbon transition and cope with climate-related risk is through strict disclosure and reporting requirements, by reducing capital requirements of financing green and sustainable activities, through the adoption of risk management techniques based, among others, like stress testing and scenario analysis, through the introduction of additional capital requirements to reflect climate risk of certain assets, or through a stepwise approach. Please vote, and while you vote, please let me turn now to the questions from our participants, and I will give you as well the chance to comment on each other's replies as well, or also on the previous replies. So let me tell you that we were very happy to read many contributions from the audience. Even like before today's debate, we received more than 30 questions from the participants interested in attending this event. And also, I've seen that there are many interesting ones in the Q&A box, which also relates somehow to the previous questions that were asked in our website. So first, participants, please continue engaging and asking the questions you may have. And I would like to ask first 2 questions, and then we'll give you the floor to comment on those. So the first question is the current available data enough to provide a fair proxy that incorporates sufficient climate factors to accurately assessing climate risk? What is your opinion on that? And the second question is, are penalizing factors more effective in triggering short-term behavior changes rather than supporting factors, which may only imply windfall effects? So please, comment. I will give you some minutes, 3 minutes for each of your answer. So please, Julia, now the floor is yours.
Thank you. I'll start by addressing the data question. I think I a little bit already referred to that in making my arguments in my introductory remarks. Basically, we do think that there is sufficient data from climate science to infer the risks of potential asset stranding on the balance sheets of the financial institutions, which are again specifically associated with fossil fuel financing. Of course, speaking and advocating for the Pillar 1 capital requirements to cover those risks, we do suggest to follow kind of a combination of qualitative and the quantitative approach, because definitely the estimates of the stranding and the estimates of the reduction in the consumption of the existing fossil fuels, they offer a very solid databases already to act on those risks. At the same time, of course, there is a qualitative element to it, because if you look at the risk weights, which are currently part of the prudential framework under the standardized approach, they are not validated in that specific manner as internal risk weights would be validated that the banks are used, but like they are also clearly qualitative and quantitative based. This is why like in the work that we are doing in Finance Watch, we suggest to use the prudential framework, the design as it is now, and apply the currently already available higher risk weights for the activities which are associated with particular risks. Usually, if we speak about the European Capital Requirement Regulation, this is 150%. And for the new fossil fuels, as I was saying, that we have an evidence from the climate science that new fossil fuels are not existing in the below 0 degree scenarios. Of course, these will be completely stranded, right? So this is a very clear mathematical and also very logical conclusion from that. And based on that, you could say that something which will become entirely worthless should be subject to full equity financing, which would mean, in the terms of capital requirements regulations, 1250% risk weight. I'm sorry, I think I stopped now for the first of the question. Can you remind me what the second one was also?
Yes, the second I was read, but I think that you already answered somehow in your, are penalizing factors more effective in triggering short-term behavior changes rather than supporting factors, which may imply windfall effects?
Okay, maybe I'll be very short on that. I think, again, we are not speaking about penalizing factors. We're speaking about incorporating the risks into the prudential framework, as other risks are already part of it, right? We are also know that in any case, in any legislation being affected in the European Union, there are transition periods, right? So nothing comes from day one to day two, which allows for adjustments, which allows also to adapt. And also, as I also already mentioned, the increase in the capital requirements for the assets already on the balance sheets is not something which will imply an outright stop, right? It will be marginal increase. It will depend also on the ratings of the fossil fuel companies as they are. It can be bigger, it can be smaller, but this is definitely something that the banks can transition to, and that the borrowers, the fossil fuel borrowers, are perfectly able to pay. So this will not have an outright impact on the availability of financing to those companies, which is again also crucial for the transition, as I recognize.
Thank you very much, Julia. So please, Gonzalo, now the floor is yours.
Thank you. Then on the first question about whether there is sufficient information to come out with proxy for the risk of climate change. First, we need to say that climate change is not a risk itself. It manifests in different ways through credit risk, potentially operational risk, even market risk. And that is the way we can measure it. And that's a big challenge because it is a multifaceted problem. That's the reason why the IPCC report is focusing on the need to bridge the knowledge gap, which is the reason why we are investing now in data and disclosures. And that report of IPCC is very interesting. It also says that what is new is that climate enters now as a factor in the assessment of financial institutions' risks and the credit ratings. External credit rating agencies are already incorporating it. And it puts Europe as an example. So somehow we are leading in that respect. But it also says that if these impacts are factored in by financial markets, they are reflected in the value of financial assets. So that has to be the first objective. If we have those factors reflected, they will be, and they are already partially reflected in the financial assets. Then you have the prudential framework. In the prudential framework, you have a variety of tools to tackle potential risks that don't manifest in a binary way as credit risk, which is default or not default. And for those, you have different assessments. What we are doing now is also investing in securing that the boards and the senior management of the banks are taking this into account in the risk assessment through the governance part of the business model analysis of the SREP. That is about information. And the second question was about the supporting factor. If you can repeat it again for me, Maria, the second question.
Yes. Are penalizing factors more effective in triggering short-term behavior changes rather than supporting factors, which may only imply windfall effects?
Difficult question to say, but in general, I mean, this is like in real life. I mean, punishments have a very direct effect, but probably not the one I would like. I prefer incentives because they are stronger in the long term, and they build the right incentives.
Thank you very much for these answers, Gonzalo and Julia both. And now we are running out of time, but I will put another question before we launch the results of the poll for and your concluding remarks. So let me ask you the following. Do you believe that in the stressful situation for the European banking sector, due to the current geopolitical context and events, would it be relevant to increase capital requirements? You have now 3 minutes each to comment on the question, please. And now in reverse order, Gonzalo, I will give you the floor.
Yes, I think we are in an ever more challenging world for the economy in the first place, and therefore for banks, because it's an integral part of the economy. The question of capital requirements. I've shown at the beginning of my presentation the current situation. You can go adding more and more capital, but at the end there is no free lunch. If you put more capital, there is less lending capacity. So that is the question. What is important and significant for me is the voluntary buffer that banks are maintaining. Of course, because the market requests that in order to finance banks and for banks to portray an image of confidence. So that 4 or 5% chunk of buffer that banks decide to keep themselves as a whole, there are different business models, there are different regions, different banks, but that is the whole banking system, is important. There's never enough. The only way to be 100% sure that the banking system will not fail is to close the shop. Then you don't fail, and you just simply close it. No, but with a 15 or 16% capital ratio, core equity capital ratio that we have now, we have been able to withstand major, absolutely unexpected shocks. So that gives us confidence, not complacency, but confidence that we are at the optimal level. So the cost involved in raising more capital are not justified. Then on the current situation, I would also call for the right balance, because it's not only about banks, of course, it is mainly and first and foremost about society. And we are navigating through a very difficult period where on the one hand, we have the greening objectives for a very good reason. On the one hand, we have the soaring energy prices. In the middle of a war, geopolitical crisis, we need to strike a balance. The European Commission published recently that there are 31 million Europeans living in what they call energy poverty, meaning to not have access to basic energy needs. So at the end, you need to think very carefully about the timeline of reduction to ensure that in the short term, people do not suffer, and at the same time, we are able to go through the transition and finance that transition in the long term. Let me just give you a tip of information. Every percentage of capital ratio is funding 2 trillion of assets in Europe.
Thanks, Gonzalo. Now, please, Julia, very brief. The floor is yours. Thank you.
Thank you. So to answer the question, if the capital requirements should be increased specifically in the current crisis situation or in the context of this crisis situation as compared to like before the war, I think I would not say that they necessarily have to be increased because of this situation, but in a sense, the situation reinforces the case for the capital requirements for climate-related financial risks, and specifically due to the two very important reasons. Now that governments realize how important the question of energy security is, also in the context of the green transition, they are likely to accelerate, right? The development of green technologies, introduction of green technologies, and get a new push to the sustainable finances and sustainable energy sources agenda, which means that the risks of disorderly and faster transition and the risks of stranding on the balance sheet of financial institutions, they will also be increasing. We are also seeing a push of certain fossil fuel companies to open up new oil fossil fields or new gas fossil fields in order to kind of jump in and firefight the situation, which also means that these investments will lock in carbon for the years to come. And this also means increased risks of stranding on the balance sheet of the financial institutions. So now, more importantly than ever, this is time to act and introduce the Pillar 1 capital requirements, because the further we go down the line, the more we are putting the financial system at risk of disorderly transition, of losses, and also at the risk of putting a financial crisis on the top of climate crisis and also energy crisis that we are anyways facing. I duly recognize the argument that Gonzalo made about societal aspect or the aspect of energy security for the people, energy poverty. These are very valid problems. However, there are also adequate economic policies to tackle those problems. We should not also take prudential framework for something that it is not, right? Prudential framework is in the place to ensure the stability of the financial sector. And this is why we should really focus on that and make sure that the financial institutions can play their part. I would also like to comment on one of the arguments now and made before regarding the necessity of releasing capital in the crisis situations to make sure that the banks retain their lending capacity. This is indeed a very valid argument. However, there are also appropriate tools for that in the prudential framework. There are buffers, the function of which is to be built in good times in order to be used in bad times, right? So that is a separate piece of the prudential regulation, and I think we are not kind of speaking about it right now at the moment, but it remains its function. And I also agree that that piece, we have to get it right. Also in the capital requirements directive in the European Union, however, it's a different kind of part than these prudential requirements, which are totally different animal in a sense. Thank you.
Thank you very much, Julia, and thanks a lot to both for these answers. I see that there are many different points of views on this matter, and but now it's time to close, unfortunately, the Q&A session because we are running out of time. But I thank all the participants for your interesting questions, and I guess that many of those were already answered in your speeches. And I would just like to note that in the previous poll, 37% of our participants, the fourth poll, consider that one of the most effective ways in which financial institutions can contribute to the low carbon economy transition to cope with the climate-related risk is through the adoption of risk management techniques based like stress testing and a scenario analysis. And now, while we conclude, I invite again our participants to vote again on the motion that you can see in the screen. And then, since we are approaching, unfortunately, to the end of the discussion, I would like to give you both, Julia and Gonzalo, 3 minutes each for your final remarks. And again, please be mindful on the time. Now, Julia, you have the floor first, please. Thank you.
Thank you. So I would like to conclude by saying that in supporting Pillar 1 capital requirements, we also definitely support all the other measures that Gonzalo has alluded to and that supervisors and regulators are now undertaking. Scenario analysis, exploring, collecting the data. These are undoubtedly very useful measures. However, we have to be mindful that due to the nature of climate risk, we will never have perfect data for this type of the risk. We all know that climate change is a very much forward-looking phenomenon, that there will not be data reflected in the past like we need for the future, because we are moving up the temperature rise, right? So the traditional ways of designing and validating risk models in the banking world will not work with climate change. We also have quite a limited window to act before we will see more and more damages inflicted to the assets financed by banks and other financial institutions due to climate-related events, because we also have very limited window to act to prevent those irreversible tipping points from happening. This is why it is very important to act timely on the already available evidence that I had outlined earlier, which will also give the supervisors and financial institutions time to keep exploring and keep learning and designing better technique to address also other types of climate-related financial risks, not only in the fossil fuel realm, but also maybe at some point come up with better measures. But by taking action now, we contribute to the transition being orderly and manageable, and we also give time to come up with those measures. We also think about the stability of our financial system, and we also make it likelier that we will be able to prevent the next financial crisis being related to the climate change. Thank you.
Thanks a lot, Julia. Please, Gonzalo, your final remarks in some minutes.
Yes, thank you. I would just will repeat some of my points. about the proposal of the Brown factor I think is the wrong tool for a right purpose. We have to say that we are all on the same boat. We all want the same, but I think the instrument at this stage is not suitable because simply it will not affect or reduce the demand for fossil fuel activities. It will simply be shifted to other parts of the financial system out of the regulatory and supervisory controls. Also, the question of the green factor is not a panacea, but at least I don't see that it has any risk. It could be helpful, but only if it is risk-based, not a policy action. The penalizing factor wouldn't help financial stability because it would reduce the capacity of banks to deal with unexpected shocks, as we have experienced in the past. And it will lock capital that could otherwise be used to finance the transition. As I have mentioned before, we have a very tight and very well experienced relation there of 15% core equity capital ratio, financing more than 20 trillion assets, meaning that if you increase that capital requirement, the effect on the on assets is multiplied, and now because of the high demand of projects for the green transition, we need to put all of our capital to that task. The question also is that this will not happen overnight. We are at the first stage and Europe is leading. That is the more important message. The right and responsible thing to do is to help energy companies navigate through the transition according to the timeline, but not pushing them to failure too soon with a higher cost of funding for them. EU banks are actively reducing their exposure to this type of fossil fuel assets, and I would like to show again this graph, because to me this is the summary of what is happening now and what needs to happen in the future. I can only say keep up the good work and go reducing, adhering to the timeline that has been set by policymakers. The green transition is a very big project for all of us that exceeds very much the scope of banking. We are just one more part of this solution, and we need to continue in that trend. Without abrupt changes in the policy. We have a policy toolbox that permits for authorities and supervisors to react immediately when something happens, and we need to keep that capacity.
Thank you very much. Thanks a lot, Gonzalo. We may take 5 minutes extra if you agree, and also like for our participants, because it's very relevant to comment, to see the results of the last poll on the motion, which were like, it's a big, well, very similar to the, so please note that now 57% of our participants think that at this stage, regulatory Pillar 1 capital requirements should not be increased to reflect climate risk of certain assets, while at the beginning, they were 53% who believed that they shouldn't. So we see like 4 points of difference increased for the ones that think that they believe they not. So now, just like before we go and say goodbye to everyone, please, I would ask Julia and Gonzalo again to comment this result in 2 sentences, please. Julia, the floor is yours now.
Quite surprising, but at the same time, I think we also have to keep in mind who the audience of the webinar was also. I think there was quite a substantial representation from the financial sector and also from the National Supervisory Authority, whereas like the academic sector was a little bit underrepresented. So I can only invite the participants to think about the prudential framework in its function, think about the fact that this is not a trade-off between financing transition and managing the risks, right? The risks is the basis for the stability of the financial system. And this is very important to remember. I think we are moving ourselves a lot in this traditional kind of framing of like what the prudential framework is and what it is not. And I think we have to keep that in mind. And I hope also that our policymakers in the current review of the prudential rules for banks, but also for the insurance companies, keep that in mind as well. Thank you.
Thanks a lot. And now I pass the floor to Gonzalo.
Well, I think it's interesting. There are different opinions. This is the European Union, and all opinions are valuable. And I think it is good that we have this type of debate. Maria, from a personal perspective and experience, I think the best thing we can do is to go talking and assessing this question of climate change continuously, with supervisors, with authorities, with banks. That's the only way that it doesn't catch us unaware. As a risk manager, the day of the outbreak of COVID, I was scared, because it's something you cannot expect, and you don't know how to deal with that. I mentioned that the banking system, fortunately, this time around was well prepared. We have to be happy about that, not complacent, but confident. However, about climate change is a question of continuing. It's a marathon. You need to keep up the pace. You cannot run the marathon in 10 minutes if you have passed through that experience. Keep up the pace you wanted until the end, and that's the way to get to the finish line properly.
Thanks a lot, and a warm thanks to our speakers for this very interesting and rich debate. There's, of course, like a lot of room to further discussions on this relevant topic. And we wish we will have more time to do that, but we thank you both. And also, I would like to thank all the participants for attending the 5th FBFDiscuss. And also, I would like to remind you that the recording of this debate will be available in our event page at the fbf.eu. And in the course of this month, we will publish as well a summary of the discussion and an analysis of the results of the polls, which will be also available on Twitter at the same time. And please also, to our participants, don't forget to follow the Florence School of Banking and Finance in social media, LinkedIn and Twitter for more FBFDiscuss, training courses, and other very interesting events. So thank you all, and I wish you a very, very nice afternoon, and goodbye.
Thank you.